In past years, you've always focused on liquidity, sometimes saying we don't have enough. Seems like we have plenty now.
I mean, it's exactly right. I mean, I think people underestimate how liquidity is functionally, what drives markets, and it's the amount of dollars that are in the system. Actually, if you think back, I was just thinking as you were saying that, back to 2018, you think about the struggle that there wasn't enough liquidity, there weren't enough dollars in the system. Well, we are in an unbelievable period now, where because of the monetary stimulus, but also the fiscal, that the pay down of the TGA, the Treasury's General Account, is actually sending more liquidity through, for the next couple of months, another 500 billion or so, just there away from the Fed's doing. So the system is awash in liquidity today, and it's fueling some of this concern about, gosh, you get some near-term inflation. I'm not sure that infusion of liquidity creates the inflation dynamic. I just think we're going to have an explosive growth dynamic that you're seeing play out. It's drawing down all the inventories across virtually everything today, and that's pressuring prices higher. But it's almost, dude, it's a surreal point in time in terms of, I've never seen anything in my career quite like this.
Well, let's go back to why we have all this liquidity, because we understand the Fed has two mandates. One of them is stable prices. The other, of course, is full employment. As what the Fed's doing right now on the monetary policy front, is it really creating jobs?
So, I don't think so. I mean, by the way, I think the Fed's done an incredible job heretofore, and I think what they did around stabilizing the system a year ago, and what they did with regard to liquidity, stabilizing the credit markets, the real estate markets, it was just, historic, incredible what they did. Today, I would argue that there's so much liquidity in the system today that doesn't create any more jobs. In fact, I would argue almost the counter, that if what happens is the way companies invest or hire or do capital expenditure is based on what they think their forward returns are going to be. If they believe that input costs are accelerating too fast, wage pressures accelerate too fast, you start to pull back an investment, and that leads to this negative loop. So I think, like I said, I think the Fed's heretofore done a great job. I think it's time to evolve the policy. Your last report on vaccine, think about where we were 6 months ago, 9 months ago versus where we are today. And, you give the Fed a lot of credit. It was the right policy 6 to 9 months ago, but things are evolving quickly, and I think policy should be symmetric to that, or at least follow on to that.
Well, let's talk about evolving the policy as you just referred to it. And I'll give you one specific example. That's mortgage-backed securities. The Fed is still buying a lot of mortgage-backed securities every month. And yet, when I look at the housing market, it looks like it's doing just fine, thank you, ma'am, without the Fed.
Not only is it doing just fine, if you said to me, what's going to be durable in terms of inflation, it will be shelter. It will be the fact that we don't have enough homes. And what's happening is home builders are trying, and they're building, and they're pumping out product as quickly as possible. You're going to get to the labor shortage dynamic. The hard thing for home builders is to get enough people to try and create enough homes. Let me give you some crazy stat relative to this. Lumber prices. If you take the average price of a home, which is a little over $300,000, lumber prices alone have grown about $36,000 on an average home. So think about what that is on an just over $300,000 home. Lumber, that's not copper, that's not everything else. Meaning you're getting this drawdown of inventory and some pretty accelerated pricing. And again, I would argue the Fed doesn't need to buy agency mortgages anymore. And by the way, the mortgage rates won't move up that much because there's so much natural demand in the system for real estate financing and for mortgage product. But to let them normalize a little bit, actually, I think will actually create a better environment for investing in mortgages.
So what should the Fed do at this point if they start adjusting their policy? And I know you're particularly concerned about the short end of the curve versus the long end of the curve, because the long end of the curve is where corporations finance themselves, and also, frankly, people buy mortgages.
Exactly right. So I think, the front end of the yield curve, there's plenty of buyers of Treasury bills. There's plenty of buyers of 2-year notes. The explosion of money into money market funds, into bank deposits. The front end will live perfectly fine without backing up of any significance or having any pressure without the Fed continuing to be involved there. But I think where the Fed needs to be over certainly the next 6 months, the next year, the next 2 years, is think about longer end interest rates. And that's longer than 5 years interest rates, because the Treasury is going to issue because of the fiscal programs, is going to issue an awful lot of debt. So if I were the Fed, I would taper down the amount of buying they're doing in the front end, save some powder for continuing to be a buyer in the longer end of the yield curve. And, in case people get too worried about inflation, in case people get too worried and real rates back up. But I would start to move your taper. I would start to taper sooner rather than later. But we have to watch, how they're going to think through that. But I would start to taper it, and I would leave the front end. I would do much less buying in the front end of the yield curve and liquidity in the front end, but focus more on the longer end and do that, quite frankly, over the next couple of years. But you can, by doing that, you can reduce the amount of size that you're doing, the amount of liquidity you're putting in a very significant way.
So, Rick, as you say, you really applaud what the Fed has done to date. They really stepped in when they were needed. At the same time, if you look at what they're talking about right now, it doesn't look like they even started that process. In fact, we've just had Rich Clara, the vice chair, again come out and say it's too soon to talk about taper talk because he talks about those disappointing jobs numbers. What is preventing the Fed from just saying we'll even think about it? Because they don't even want to think about it right now.
Some of that is optics. Some of that is, this commitment to more jobs, a commitment to companies to hire, and that they will be in an accommodative framework. Listen, I just don't think today, given how much they've done, I don't think that, in fact, I don't think tapering is that scary at all. I don't think, I think hiring will continue. I think that last jobs report was anomalous relative to, and I think it'll be very interesting to see the next one, because when you take the seasonal adjustment out, there was actually a lot of hiring in the last one. And if you look at job openings through every survey, they're extremely buoyant, and the claims data, all of it suggests that hiring is going to take place. It's got a real momentum to it that won't, because of the Fed tapering, will not slow down in any way, shape, or form. So, listen, the point I think you can evolve the policy and still be accommodative. My only point is, move away from emergency conditions. You don't have to buy agency mortgages. You don't have to buy the front of the yield curve. Move away from an emergency. And actually, I think the markets and I think corporate CEOs, CFOs, treasurers will respond quite favorably to that. And I don't think it will have any debilitating impact on hiring whatsoever. In fact, I think because the markets will be more stable, investment will be more stable, I actually think it'll enhance hiring.
It certainly appears that the Fed is very concerned about moving too soon. What are the consequences of moving too late? What if they do, in fact, move too late? How could that hurt us?
Yeah, David, that's a great question, and I think people underestimate that. Listen, the discussion every meeting I have is all about overheating. The first, second, and third questions are overheating, inflation, what's the risk? And so, that starts to work its way into the psychology of not just investors, but also in terms of corporates, et cetera. So anyway, that's a big deal. Distortion of financial assets. We've seen this play out over time. You now have an economy that is not a traditional manufacturing economy. The financial system is much more intertwined with the real economy that's ever been before. If continuing to inflate asset prices, particularly in some of these safe or high quality assets, forces people to take more risk to hit their return objectives, or take more risk to hit their liability objectives. And that becomes a really risky paradigm the longer that goes on. So it's the overheating, it's the inflation of asset prices, and so creating more of a soft landing that makes, you've seen that over time. When policy is effective, it creates a soft landing that you don't notice. Right. The fact that policy is moving from emergency to easy to more normalized conditions.
So, Rick, finally, give us some investment advice here. You're responsible for placing an awful lot of money, debt and equity, for BlackRock. What is the sensible investment strategy given all that we've just talked about?
Listen, I think for the time being, like I said, I think the markets have become a little jittery. They are a little concerned about some of these concepts we talked about. So I think keeping some powder dry, we're holding higher levels of cash than we've had historically. But I also think equities are going higher. When you look at, I think you're going to see this tremendous growth. It leads to corporate revenue growth, earnings growth, cash flow growth. So I would still like equities. I like owning a lot of yielding assets, securitized assets, things like we talked about in the residential real estate, even the commercial real estate area, I think makes a lot of sense. And some of the credit markets, get some yield in a portfolio, take some equity in the portfolio, some of the alternatives make sense. But I'd hold more powder, because I think we're going to see the second half of the year, I think you're going to see some real volatility. And I think, making sure you've built some convexity into your portfolio. We use a lot of options to make sure we've got some convexity in the portfolio, more cash, run a bit more conservative than you would have 3 to 6 months ago, because we're in a bit of a transitional period here.